Namaste, my dear friends. In the last class, we referred by discussing elaboratively the concept of export procedure and import procedure. Now I am referring to you, in the case of import takes place, you being an importer required to submit bill of entry to claim the ownership on the imported goods. At the same time, if the department satisfied with your bill of entry where you have been self-assessed the value of imported goods at CIF value and computed the duty thereon, the Department of Customs will return back to you the bill of entry to make the payment if you want to clear the goods from customs for home consumption by submission of white bill of entry. In that case, my dear friends, in that case, you have to pay the duty on the same day, the date on which the department returned the bill of entry to you. If you delay to pay, Section 47 subsection 2 of the customs law specifically says that you have to pay the interest at the rate of 15% per annum for the number of days delay minus holidays. For the balance number of days, you have to pay interest at the rate of 15% per annum. These are the points we referred in the last class. Now I want to bring to a notice here, bill of entry, while you preparing, you have to arrive self-assessment the value of imported goods. How to arrive this? Refer the valuation rules. Customs valuation, determination of value of imported goods rules 2007 as amended from time to time up to Finance Act 2022, which is applicable for your forthcoming exam of the December. If there is a case, my dear sir, I am bringing to a notice the procedural aspects with regard to valuation of imported goods. The first and foremost, you have to refer the rule number 3, transaction value of imported goods, where the importer exporter is not related party and the price is a sole consideration for such particular import, and the importer not sharing the sale process with the exporter, then in that case, my dear friends, the transaction value is applicable for you, and whatever you arrive the value by inviting the attention on the part of the rule number 10, which is none other than cost of services, all the expenditure which are in the nature of pre-shipment considered for valuation while computing the CAF value. All the expenditure which is post-shipment expenditure generally should not be considered for valuation of imported goods while arriving the CAF value, says rule number 10. Under rule number 3, you take the help of the rule number 10 and arrive the value of imported goods, and with that self-assessment, if the department is satisfied, automatically it becomes a final assessment for you. So in this process, I am bringing to a notice the rule number 10, cost of services. What are the expenditure which are pre-shipment nature addable in the value of supply? A clear-cut statement I have prepared for a kind consideration, which is as follows. Look here, my dear. Statement showing computation of assessable value for imported goods. Computation of assessable value for imported goods, which always measured at, as you are aware of that, CIF value. Am I right? It always measured at a CIF value. CIF value, cost, insurance and freight. In this process, rule number 10 has two segments, pre-shipment expenditure and post-shipment expenditure. Rule number 10 says pre-shipment expenditure only should add in the value of supply, value of imported goods. Post-shipment expenditure, for the God's sake, do not add unless it is a precondition for import. What is a precondition for import? I will explain to you. Don't worry at all. For the time being, my dear friends, you can able to look here. What do you mean by pre-shipment expenditure? That is important to note. Assume a scenario, my dear. Assume a scenario. Here, I am bringing the goods in a vessel. You tell me insurance and freight from the exporter country port to the importer country port. The freight insurance is a pre-shipment or post-shipment. How to understand, sir? I will tell you. I will give one clarity here. Assume a scenario. If there is vessel, assume is a vessel carrying the goods, is the goods. Vessel sailing from USA to India to Chennai port is the goods and reaches to Chennai port where docks goods lifted from the port or from the vessel and landed on the landmass of India. Up to the point of goods landed on landmass of India, all expenditure is called pre-shipment, meaning thereby point of importation. When the import gets completed means only when the goods lifted from the conveyance and landed on the landmass of India, up to that whatever expenditure pre-shipment nature. One way or the other, the import completed once the goods landed on the landmass of India is a place of importation. All expenditure up to that point is pre-shipment expenditure. One should add in the value of imported goods. After that, the goods on docks at port. If these goods at port with the under the custody of the Port Trust Authority of India, if you not clear that goods within 3 working days from the date of landing on the landmass of India, from the port, you have to remove that goods as importer. If not removed, then that goods on which port demurrages charged by the Port Trust Authority of India, which is after the import completion. Resultantly, it is called as post-shipment expenditure. Port demurrages we should not add at any circumstances in the value of imported goods. After that, handling charges at port, loading, unloading, transporting from the port to the factory of the importer, freight, insurance, this and all after the completion of the import. Resultantly, it is not going to add in the value of imported goods. And installation expenditure at the premises of the factory of the importer obviously is a post-shipment expenditure, should not be added in the value of imported goods. So resultantly, I am bringing to a notice the statement showing value of imported goods, namely assembly value, none other than CIF value for imported goods. Keeping in mind all pre-shipment expenditure is addable, all post-shipment expenditure is not addable unless post-shipment expenditure is so warranted to add. Now presenting here, look, material cost, who incurred? Exporter. Handling charges, overhead charges at exporter country, exporter factory, incurred by the exporter. All expenditure, and after finish the goods carrying from the factory of the exporter country, exporter factory, to the place of the exporter country port or airport or land port, as the case may be, that transportation, that insurance at the exporter country up to the place of loading the goods on board, namely into the vessel. All expenditure, as aware of that, is incurred by the exporter. From the importer point of view, it is a free on board. Resultantly, that expenditure, first you have to consider here all these expenditures. First point number 1, material cost, ex factory price. Second one, carriage, freight up to the place of the exporter country, port or airport. Other handling charges at the exporter country port or airport. We got it. With that, we got FOB value. This FOB value, my dear, FOB value, we got it. Very good. This FOB value of whose FOB value it is? This FOB value of whose means it is FOB value of exporter. exporter. Here you have to understand exporter FOB value. Exporter FOB value. FOB value of exporter. Then it is further to be added. If not added, rule number 10(1) expenditure. What are they? Commission. What are they? Commission. Are you getting the clarity, my dear friends? There won't be any lag in between of my explanation and voice, audio, video, both are seamlessly is visible by you at your end. Fine. So further listen, my dear friends. Further referring here, the commission and brokerage. Commission and brokerage is expenditure which is generally incurred by the exporter, by the particular exporter or the importer, whoever wanted to sell the product or who want to buy the product. It is in the nature of pre-shipment expenditure, obviously addable. However, what is not addable here is buying commission should not add. Why buying commission should not add, sir? One can ask me a doubt. Sir, buying commission is nothing but what you know, my dear. I will tell you here. Buying commission means like this, you will understand. Here, I am presenting selling price. Selling price. Here, selling price. For example, my dear, rupees. Selling price rupees 100 per unit. Sometimes selling price furthermore reduced to 80 rupees per unit. Sometimes furthermore reduced to the selling price furthermore reduced to 60 per unit. Why it happened so? Because in the given case what happened, no my dear sir, in the given case the quantity, if you purchase quantity, what manner you have to purchase here means here 10,000 units. 10,000 units if you purchase lot by lot, 100 rupees per unit. If you purchase the units, 1 lakh units, 1 lakh units, lot by lot, each lot 1 lakh units, selling price 80 rupees. If you purchase the 2 lakh units, in terms of number of units what you purchasing is 2 lakh units. If so, selling price 60 rupees per unit. Therefore, what happened? 100 rupees to 80 rupees, 20 rupees benefit is given. 80 rupees to 60 rupees, 20 rupees benefit is given. If you purchase more and more quantity, price will be less and less. It is none other than what type of a bulk purchases, discount is given. It none other than, my dear, it is none other than quantity discount. As you are aware of that, is nothing but quantity discount. None other than quantity discount. If that is the case, my dear sir, quantity discount, or otherwise we can call it as the trade discount, whatever you may be called here. In the given case, the more quantity you purchase, more benefit is given to you. It is called as buying, more buying. So buying discount, namely buying commission, one way or the other. As a result, such a buying commission should not add into the value of imported goods. At any circumstances, we should not consider buying commission should not add into the value of imported goods. If that name buying commission comes into picture, keep separating. However, commission you can add, selling commission you add. In Indian rupees, if they given, you can consider. In foreign currency is given, you can consider. Sir, importer paid commission in Indian rupees, add it. What is not to add in the value of supply here is buying commission, which is none other than bulk discount, where you are getting the benefit in the name of discount, which is nothing but commission, buying commission. More quantity buying, more discount. It is called as buying commission. Buying commission should not be added in the value of your imported goods. Further, my dear friends, you identified what first? FOB value of whom? FOB value of exporter. FOB value of exporter. Then to that value, you are adding further rule number 10(1) expenditure, which is none other than the commission, brokerage, but not buying commission. Further, packing cost. Packing cost addable. There are following types of packings. As you are aware of that, packing cost is like this. Packing are like this. There are different types of packings we have. Here, if you refer, my dear sir, packing will be like this. One is primary packing. Primary. Primary packing means what? If you are selling medicine, or why you are selling, let us say, what we can call here, water bottle, 20 rupees water bottle, 1 liter water bottle. Water cannot be sold without the packing bottle. Such a bottle is called as primary packing. Such a primary packing should add in the value of imported goods as a pre-shipment expenditure it is. Further, what is to be added here is secondary packing. Secondary packing, as you are aware of that, such a water bottles packing in a polythene pack cover with the what we can call here preventing from dust and other what we can call rain. Therefore, the water bottles packed in a particular plastic bag is called as secondary packing. Also be addable in the value of supply. Furthermore, one more packing is there. Sometimes the buyer, at the request of the buyer, special packing. Special packing. Special packing means what? On such containers, water bottle containers, each water bottle container containing 20 water bottles and packed with the polythene cover. Apart from that, special packing to protect furthermore with the, what we can call packing with the what we can call furthermore leather case. In the leather case it is kept, or it is in a plastic trays it is kept. The plastic tray is a special packing. All these are can be considered as addable value as a pre-shipment expenditure. Packing, primary packing, secondary packing, special packing. But what is not addable in the value of imported good here means, my dear sir, I will tell you. Here what is to be not add here is, look here, durable and returnable pack. What do you mean by durable, returnable packing? Container packing or water bottles stuffed in the tray. There is a primary packing, secondary packing, special packing. That water bottle trays kept in a big container for transportation purpose. After delivering the water bottles along with the tray at the destination, the container will return to the manufacturer or the seller. In such case, such a container packing should not be added in the value of imported goods. Further, my dear friends, referring here furthermore, presenting cost of engineering, development and plan and sketches. These and all pre-shipment expenditure only when if it is incurred outside India. It is very important to note. Keep in mind in the examination that fellow will confuse you by giving pack this design and development charges incurred outside India. in USD so much. Design development charges incurred in India to the imported machinery in Indian rupees so much. So design and development, two different values are given, but where you incurred this expenditure, is it incurred by you outside India, is incurred by you in India, is important to note. If the design and development charges incurred outside India, that alone should add in the value of imported goods. Otherwise, you should not add. If the expenditure of design and development plans sketches incurred in India should not be included in the value of imported goods. Further, royalties and license fees. So, royalty and license fees generally liable to pay by the manufacturer to the owner of the copyrights. Sometimes before I can able to say to you, sir, the Reynolds ballpoint pen, which is owned by France company in India, GM Pens International Private Limited, earlier used to pay the royalty to manufacture it in India and to sell it in India. In that case, such a royalty, a license fee not paid to the foreign by person, then it is not allowed to manufacture. It is none other than one way the other value of imported goods only. Is a form part of this cost of services is a composite nature. Predominant element is import of goods. To the value of the import of goods, these are all cost of services which are pre-shipment nature should be add. Royalty, license fee, pre-shipment add. Value of subsequent resale in India. What happened? The value of the goods in India worth rupees 1 lakh. But the exporter says from outside India, hey, Mr. Importer in India, I am going to export to you at rupees 10,000. You import at rupees 10,000, pay the import duty on 10,000. After that, that goods you sell at 1 lakh rupee in India because the worth is 1 lakh rupee. Then that 1 lakh rupee when you sell in India, 80% of 1 lakh rupee, you please supply back to me, return back to me the value of particular sale proceeds. Like that, the goods are imported, and the value of the goods where the importer is sharing with the exporter after sale in India, the value should be added in the value of imported goods. Repeating again, 1 lakh worth of the goods, exporter, importer collude with each other and importing at rupees 10,000 and paying the GST, import duty on 10,000 instead of on 1 lakh. And after importation, after payment of duty on 10,000 of the value of the goods, the worth is 1 lakh, selling in India at 1 lakh, and the sale prices are realized. Then the importer says 80% of that value, 80,000, is giving back to the exporter. In that case, in the given case, the importer, if imported the goods sold in India, sale proceeds are sharing with the exporter, that value should add in the value of imported goods. Because undervalued no earlier. Further, value of material supplied, if any, by the importer before importation to the exporter should add in the value of imported goods. Value of what we can call material supplied by the importer before importation to the exporter, and using that material the exporter has been finalized the finished product and sending back to India. In that case, the value should include the value of material supplied by the importer to the exporter. So all these expenditures, if you sum up all these expenditures, you will get one more FOB value, that is FOB value of customs. Earlier, FOB value of whom? Before adding this particular rule number 10.1 expenditure is FOB value of exporter. Got the clarity? Now, by adding this all expenditure, pre-shipment nature, we got FOB value of customs. FOB value of customs. To the FOB value of customs, further you have to add rule number 10 to expenditure, which is a little bit careful. These expenditures, my dear sir, these expenditures at any cost should not add in the value of FOB value of customs. You have to add to the FOB value of the customs, not form part of the value of the customs. Repeating again, this expenditure, what are they? Freight, insurance, ship demurrages, Letter A is bar charges. These expenditures, what I mentioned here, should not be included in the FOB value of customs, should add to the FOB value of customs. That means these expenditure should not add in the given values. Here you should not add. This expenditure you should not add here, is the meaning what I try to say here. Now come back. These are the expenditure also pre-shipment nature, but should not form part of the FOB value of customs. It is to be added to the FOB value of customs. What are they? Freights are from exporter country port to the importer country port. Freight, add it, pre-shipment, because the goods not landed in landmass of India, import not completed, therefore the pre-shipment expenditure. Insurance from exporter country port to the importer country port, transit insurance should add in the value of imported goods, namely to the FOB value of customs. Ship demurrages. What do you mean by ship demurrages? My dear sir, assume a scenario, a vessel sailing with this particular goods, is the goods, vessel sailing with this particular goods and reaches to port, let us say Indian port, Mumbai port, unable to get a berth place to halt, hook the langar for unloading the goods because traffic jam at Mumbai port. Sir, what you are telling, sir? Coastal area is open area, so much of space is available. Where there also be traffic jam, sir? Yes. Otherwise, what happened? No, if the vessel is reaches to a other than the designated area, then due to the overweight of the vessel, it may possible to stuck in the sand. You and me cannot go and pull. Not possible. That's all. The life is over. Ship vessel life is over. Once happened Chennai port, a vessel instead of reaching the port, it is went to other than the designated area of the port. Because of the depth of the sea is lesser in that area, it got stuck in the sea, a particular sand. Resultantly, it has been further opened for exhibition, for kind consideration. See, we have major ports. Mumbai is a major port. After that, Cochin is a major port. After that, Chennai is a major port. After the Chennai, Vizag is a major port. After the Vizag, Paradeep is a major port. Like that, we have designated different areas as a major port. In between, so much of coastal area, open area. From Rameswaram to Chennai, coastal area, open area only. But vessels are not able to go to that coastal area. Reason that coastal area, the depth of the sea is lesser, which is suitable for the port means the particular shore, particular coastal area where the depth of the sea is too huge. The goods carrying the vessel with overweight smoothly can sail. So a vessel came to Chennai port, halted outer anchorage far away from the port and waiting for the want of berth place. 1 day, 2 day, 10 days are over. After that, the vessel got berth place, came to nearby the port, hooked the langar and unloaded the particular goods on the dock. Shipper company says, "Hey Mr. Importers, because of you people only I came to Chennai port. Unfortunate, unexpected delay happened. Therefore, you pay charges to me." Like that, shipper company is collecting the charges from the importers is called as ship demurrages, which is before import completion. As a result, pre-shipment expenditure such as ship demurrages, be careful, should add only in the value of rule number 10 sub number 2 by adding it to the FOB value of customs. Do not take that expenditure and include in the FOB value of customs. Do not do that. Ship demurrages under the form part of the rule number 10(2) expenditure, which is to be added to the value of FOB of customs. Likewise, we have the literage or bar charges. We have here literage or barge charges. What do you mean this? How to understand this? I will tell you, my dear friends. By showing a clip, I will able to present this for your kind consideration and more visualization. Literage or bar charges, how to understand it. If you refer here, there is a very big mother vessel. Here is a port. This area is called as port. This area is none other than port, or also we call jetty, or otherwise we can call it as the dock, port. The vessel is far away from the port because the huge voluminous of this particular vessel, it is not feasible to come nearby port, is away from the port. The goods from here, goods, there are so many goods here. These are the goods. Here the goods are there, here goods are there, here goods are there. These are the goods should come to the port, for which there are small boats, small boats. We call them transshippers, going nearby the mother vessel and showing boat note to that particular inches of the vessel. Hey, Mr. Master of the vessel, please permit us to clear the goods from your vessel to carry to the port. Master of the vessel, by verifying your boat note, yes, hey, Mr. Transshipper, you take the goods here. The goods are available here. You load in your place. These goods are yours. These goods are yours. Like that, permission given. And goods are bringing from mother vessel to port by these transshippers. That expenditure is called as barge or letterage charges. In that case, such a barge charges is a pre-shipment or post-shipment. These goods yet to land on the landmass of India, therefore pre-shipment. Resultantly, these expenditure should add in the value of imported goods. These expenditure should add in the value of imported goods. If where to add in the rule number 10 to expenditure, it should be added to FOB value of customs. Should not form part of the FOB value of customs. Along with the ship demurrages, letterage or bar charges should add to FOB value of customs for finding the CAF value. So now please come back. Once you understand the ship demurrages, letterage or bar charges, bringing to your notice the concept of freight and insurance. Concept of freight and insurance. Now coming to this point, my dear sir. Coming to this. Cost of freight. Cost of freight. How to understand this? Cost of freight. I'm talking about freight charges. Freight. How to understand the freight? Freight. What freight we're talking about? If the goods are coming by air, it is air freight. If the goods are coming through sea, sea freight. If the goods are coming by land route, it is just freight. Now, what freight it is? From the exporter country to the importer country, freight charges, pre-shipment, addable in the value of imported goods, no doubt. Where to add? Add to FOB value of customs. If there's a case, actual sea freight add it. Freight, add it. If it is a air freight, such air freight should not exceed 20% of the FOB value of customs. That is important to note. Here I am bringing the importance of the FOB value of customs. Listen, my dear sir. Bringing it on notice. Hopefully you understand this. Here, let us say FOB value of exporter is Indian rupees, is rupees 1 lakh is there. After adding some other expenditure, rule number 10, one expenditure as a commission, brokerage, that and all, you will get here FOB value of customs. How much it is rupees 2 lakhs. There are two values we got, FOB value of exporter followed by FOB value of customs. Now here there is actual air freight. I will say that actual air freight paid to air cargo is, for example, is rupees 45,000. As long as, my dear sir, if you come across your air freight, you come across here air freight. If that is the case, such air freight should not go beyond 20% of the FOB value of customs, not the FOB value of exporter. Is the rule number 10, sub number 2 specifically says. If that is the case, here which value should be considered to add FOB value of customs to identify CF value, which air freight should be added means here you have to compare this. Here you have to compare by saying that 20% of FOB value of customs, 20%, or further actual air freight, whichever is less should be considered for our computation. This is very important, my dear sir. One can able to test in the examination. Many occasions it has been asked in the examination. FOB value of customs or actual air freight, whichever is less. Now, when we talk about 20% of your actual air freight, how much comes 20%, my dear? 20% of a FOB value of customs is 40. Yes, you are right, 40,000. Then this value you got it. Then actual air freight given here at rupees 45,000 is given. It is to be paid to the air cargo wala. Generally air freight is much higher than that of the sea freight. Therefore, for the benefit of our importers, the government said in the case where actual air freight what you are going to pay to your air cargo is exceeded 20% of the FOB value of the customs, in that case, the FOB value of the customs on which 20% sufficient to add for finding the CAF value, not actual freight. So I brought your notice simplifying it 40,000, namely 20% of the FOB value of customs, or 45,000, namely actual air freight. Among the two, whichever is less. Which is less here? 40,000. That alone should add in the value of rule number 10 to FOB value of customs to identify the CAF value. What is my purpose to identify here? CAF value. So here in the given case, FOB value of customs I have taken, and here I am adding of what? Adding of, let us say, freight. Freight, how much I have to add here? Means I am going to add here, the freight is rupees 40,000 only. I will going to add here, not the 45,000. Further, sir, what about freight not known, sir? If the freight not known, standard 20% FOB value of customs to be considered. Says rule number 10 to freight not known, 20% of the FOB value of customs. Freight known, given freight is air freight, be alert, 20% of the FOB value of customs or actual air freight, whichever is less, what I explained here. Further, other than this, further, there may be sea freight. If the sea freight is what is given actuals, do not hesitate to take. You take as such. Sea freight, this 20% concept not applicable. If the sea freight is given, that actual should take. Sea freight not known, then only 20%. Sea freight given, actuals you take. Do not apply 20% concept. Further, I want to find out CF value of imported goods, which is my accessible value of imported goods. Now I came to know freight. I want to know insurance. When we talk about add here, insurance given a insurance, from where to where insurance? From where to where insurance it is? The insurance from from the place of exporter to the place of importer. That insurance only I am talking. So that insurance pre-shipment expenditure. In that case, that insurance is given given, sir. As such you take it. Do not further question it. It may be goods coming by air, through sea, by land route. No problem, my dear. Whatever given actual air freight, actual insurance, maybe goods coming by air, to cover the transit damage by air, insurance taken. That insurance given, you take it as such. Do not compare with anything. Insurance if given, you take it. Do not compare with anything. If insurance not given, and it says sometimes not known, not given, not known, be alert. Sometimes we may forget also. Be careful. While arriving the value of imported goods, all our imports are measuring at a CIF value, cost, insurance and freight. Without having the insurance, you cannot get the CIF value. Without having the CIF value, you cannot arrive the assembly value for imported goods to pay import duty. If you're not going to pay import duty, Department of Customs not permitting you to clear the goods from the customs. Therefore, it is that much important. Insurance, if known, take as such. If not known, not given, in that case, you have to take at the rate of 1.0 125 percentage. On what? On again FOB value of customs, not FOB value of exporter. This is on FOB value of customs only you have to take, my dear sir. How much it is? If not known, in that case, take the calculator and apply on 2 lakh. Which is 2 lakh what? 2 lakh is nothing but FOB value of customs, on which 1.125 percentage is a 2250. 2250. Once you got this value, my dear sir, easily can identify your CIF value. Yes or no? CIF. How much CIF? Very easy to identify now, which is nothing but your 2,40,000 plus 2,250. So 2,42,250 your CF value. Once you got the CF value, this CF value is the assembly value for imported goods. If there is a ship demurrages, if there is a letterage or bar charges, that also be add here only. Along with the freight insurance, you have to add it to find out the CF value. Is the way in which you have to arrive the value for imported goods. If you arrive the value for the imported goods like this, 2,42,250, custom duty apply. I will also apply here. Here custom duty. There is custom duty. Basic custom duty. For example, 12 percentage. 12 percentage on what? 12 percentage basic custom duty you have to apply, my dear sir. Carefully listen. On the assembly value of imported goods. This particular 12% you have to apply. On what means? On this value. On this particular value. I will remove this here. On this value. 12 percentage. How much comes here? Sir, I got here 2 lakh. I got here 2,42,250. On which 2,42,250. On which the 12% basic custom duty, which is comes here almost all for me 29,070. Thereafter, whenever there is basic custom duty on imported goods, there must be social welfare surcharge, which is standard at 10 percentage. This social welfare surcharge 10 percentage on what you have to calculate, on what you want me to calculate here. Here, my dear friends, this value should be calculated. I am presenting here for a kind consideration. This particular 10% is should be calculated on the value of the above, namely BCD, on this BCD on CF value. Social welfare such as automatic, problem gives or not gives, where there is import of goods, BCD will apply social welfare surcharge. However, on account of export, if there is a BCD, that alone will apply. It won't apply further social welfare surcharge. Social welfare surcharge is not applicable if the goods are exported on which BCD is going to pay. Social welfare surcharge 10% is applicable automatically on imported goods where you compute the BCD. BCD goes hand in hand with social welfare surcharge, this value. Further, this 10% comes here how much? The 10% comes here, as you are aware of that, 2,907. So with this, you got the total BCD. How much the total BCD you got, my dear, here? Total BCD is nothing but, in the given case, 31,977. Here it is nothing but 31,977. You got. This is custom duty. Okay. Now, if there is IGST, what is IGST? IGST nothing but additional custom duty under the section 3, subsection 7 of the Customs Tariff Act 1975. What is additional custom duty? Is equal to IGST for the given product in India. If there is interstate supply, what is the IGST applicable for the given product? The same rate is applicable for import of such goods. For example, in India, if I am selling this particular product, this calculator I am selling in India, IGST applicable 12%. These goods if import, in the name of additional custom duty, I have to pay, namely equivalent to IGST, is none other than 12%. Same product. If this product applies, in India, if this product is applies 28% of IGST in India, such a product if I import, in addition to the basic custom duty, I have to pay additional custom duty, which is none other than the IGST, which is at the rate of 28%, because the product is applicable in India, IGST 28%. Therefore, if I imported, will also apply 28% of import duty as an additional custom duty, in addition to this particular basic custom duty. The basic custom, how much is mentioned here? 31,977. In addition to that, IGST will apply. Now, assume a scenario for a given product, there is a IGST under the Customs Tariff Act under section 3, section 7 as an additional custom duty. That additional custom duty here comes rupees, how much will come? If the IGST is, in the given case, if the IGST is at the rate of, for example, the given product applicable in India, assume a scenario, I imported this particular product, some product, this product I imported, a product which has some futures apple product imported. This product in India, applicable rate of IGST 18%. If I import this product, I have to pay IGST equal to the product applicable rate in India, which is 18%. 18% I am liable to pay. If I am going to pay IGST 18%, this 18% on what value? Important to note. My dear friends, as you are aware of that, the value of supply for the GST purpose. Refer section 15, subsection 2 of the CGST Act, where we understood all taxes and duties should be added except GST taxes. All taxes and duties should be added except GST taxes. So here, what type of a duty it is, tax it is? Custom duty, cess, surcharge, which should be added in the value of supply to apply IGST. Therefore, I am going to add this now. IGST is calculating 18% on what value means, you know, my dear sir, on 2,42,250, the value of a CFL of imported goods, plus my custom duty, including social welfare surcharge, 31,977, and the total I have to apply to find out my IGST. So 2,42,250 plus 31,977. How much comes here? Totally 2,74,227. Am I right? On which 18% is equal to, how much comes here? Tell me quickly, fast. 49,361. You should have say well before I presented. So you should be act fast. So 49,361 is the IGST. Now, what is the total import duty? Means total import duty here is together basic custom duty, thereafter the what we can call the social welfare surcharge plus IGST. So total custom duty is equal to this, which is nothing but is as follows. As follows. 31,977 plus 49,361, totally 81,338. Total customs duty 81,338. So is the way in which you have to identify. So now importance here is FOB value of exporter required to find out FOB value of customs. Once we have FOB value of customs, that is a base for us to compute the freight 20% or insurance 1.125% only on FOB value of customs, not on FOB value of exporter. Is a way in which you can able to identify the value of imported goods by inviting the rule number 3, sub rule number rule number 3, read with rule number 10. Rule number 3, transaction value. Rule number 10, cost of services. Which cost of services should be added? The pre-shipment should be added in the following manner. Breakup.